Hi there, my friend. I'm Peter Barron. Welcome to today's episode of the Independent School Moonshot Podcast. I am thrilled to welcome Robert Ryan. He's a director at First Tryon Advisors. And First Tryon is a firm that helps independent schools think through building strategy, secure funding, things of that nature. And Robert will tell you more about that in a second. They also just came out with this report that I think is fascinating, and I'm hoping, if you're listening to this, you'll go grab a copy after. It's called "The Independent School Financing Landscape," and there's just so much in there in terms of thinking through strategy, understanding what's happening, and if you listen to this pod, I love to dig into things, so I'm super psyched to dig into this one right now. But before we do that, Robert Ryan, welcome to the podcast.
Peter, thanks so much for having me. It's a pleasure to be back on.
Yeah, I'm really excited for this one. And we're going to dig into the report in just a little bit. Before we do, though, can you introduce yourself, first trying the work that you do with independent schools? I think that would be great.
Yeah, I appreciate that. Um, I've been with First Tryon for a little over 7 years now, maybe 7.5 years. First Tryon is a financial advisor that's dedicated to working with nonprofits throughout the country. We specialize in K through 12 institutions and helping them think through their strategic financial plans. So typically that involves financing new facilities, refinancing existing debt. We've also expanded into advising on investments as well, endowments. So both sides of the balance sheet, assets and liabilities, we're helping our clients think through and execute on long-term strategic plans.
Yeah, and like I had mentioned in the upfront here, that you just recently republished this report. I think it may be the first publicly available data report on independent school financing in the public markets, which is fascinating. So I guess the question is, like, why? Like, what gaps were you trying to fill, and ultimately, who did you write this for? Who is your primary reader?
Yeah. Well, we noticed in the market there was, as you mentioned, a dearth of publicly available information to allow heads of schools, CFOs, board members to make an informed decision on what was available to them in terms of the tools in the toolbox from a financing perspective, right? I'm in this business, so are my colleagues every single day. So I think we take for granted the level of knowledge and expertise that we bring to this and just how we can see so many moving pieces on the chessboard and how one side of the market is maybe beneficial to a borrower versus the others, but that's because we sit at the nexus of a lot of the upstream and downstream information and can see that day in and day out. A lot of our contacts and clients don't have that level of information or access to these data sources. And so we decided to create something on a periodic basis that allows for them to kind of just check in on the markets, particularly on the public side, since that's the most available. We have done this before for other parts of the K through 12 space. We've done it for public charter schools as well for several years now, and do it on a semi-annual cadence. We're planning on doing something similar for the independent schools going forward. So you'll probably see another one of these shortly after this mid-year, or possibly into the end of 2026. We wrote this to provide enough level of information for folks to have an understanding of the markets, but also try to create key takeaways for people who aren't financially savvy in terms of understanding the capital markets and the intricacies of the fixed income securities we're talking about here, to know, hey, these are the key takeaways. This is what I should be looking for. And most importantly, this is what I should be asking my partners, whether it's a lender or an underwriter or a financial advisor, so that I make more informed decisions and can bring it back to my key stakeholders and help them make more informed decisions. So, again, I think, like you said, Peter, it's probably the most comprehensive publicly available information that we've seen out there in the market, and we're committed to continuing to provide that on behalf of our clients and our contacts in the industry.
Yeah. So I imagine most people who are listening to this they're familiar with the idea of borrowing from private institutions, maybe a bank or something of that
Yeah.
nature. But if they haven't thought about the public markets, I guess, like, let's level set. What's the difference, and when does it make sense to say go private lender versus the capital markets?
Yeah. So what we typically see is sort of a normal distribution of borrowers along both the credit spectrum and the amount that they're borrowing, right? So you've got within two standard deviations of the mean, so 95+% of borrowers in the independent school space, they're probably better off going with a private lender, a commercial bank, or friends and family, or what have you. Um, Probably because their credit is right in the middle. They're not AAA. They're not junk rated. And the borrowing size is not 100 million plus, and it's not 5 million or less, right? It's probably somewhere where they're doing a new stadium or they're doing a new facility that's going to be somewhere between 10, 20, 30, $40 million. And they've got strong, okay, or middle grade credit. That's going to be the majority of private loans and lending that we've seen. One key statistic that we sort of brought out of this when we looked at the data is there are thousands, maybe tens of thousands of independent schools in the country, depending on how you define them. But in the past 2 years, in 2024 and 2025, there were less than 30 publicly offered securities for independent schools. Which, if you think about just any point in time in 2024 and 25, how many of those tens of thousands of schools were borrowing for whatever project they had, just to have 30 of those be publicly offered kind of speaks to the self-selection part of that. The key difference, I would say, is in the complexity and just the undertaking that a public security has, and some of the flexibility that it comes with versus the pricing uh, for the borrower. Again, on one end of the spectrum, if you're a AAA, you sort of can set the price that you're going out to the market for. If you're in the middle ground, it's a little bit more difficult. You've got to do some negotiation aspect on there. If you're in the lower side of the credit spectrum, you're a startup school, maybe you've had some issues in the past. A regulated lender like a commercial bank probably would not be able to lend you a significant amount of money. So you may need to go into what's called a private placement of debt through an underwriter with a particular investor that specializes in this market. They're called qualified institutional buyers, and they're allowed to take on through SEC rules, more sort of high yield and speculative investments. And so they're the ones that really serving those startup, B non-rated type of schools that are looking for more speculative debt for projects or startups.
So, Robert, your data shows that about 20% of independent schools pursuing public bond offerings use a registered municipal advisor, but 70% of colleges and charter schools they use the advisor. So, I'm curious. First off, explain what the municipal advisor is, but why is there that disconnect, and is there any cost to that disconnect?
So the registered municipal advisory category was created shortly after 2008 in the financial crisis to make sure that there was an advisor out there serving nonprofits, K-12 institutions, and looking out for their best interests from a fiduciary perspective. All of our advisors at First Tryon are registered municipal advisors, having passed the Series 50 license. And we do find it quite interesting that there's not a majority of independent schools seeking public bond financing, engaging independent municipal advisors to support those transactions. Oftentimes, they'll work with a single investment bank. Um, we think, and others in the industry think, that it's best practice to include an independent advisor that's a fiduciary to you, that's negotiating on your behalf, and making sure that the financing is suitable and for you and being executed in the best terms possible. I can't speculate necessarily why most independent schools borrowers don't use an MA. Could be a possibility of lack of awareness that even exists in the market. That category of market participants was only created less than 20 years ago, versus a long lifestyle of or lifespan of a lot of the independent schools out there. Um, I think it's also possibly that there's just few independent school public bond offerings out there as well, and so it could be just a low sample size in any given year. But again, we think that it's best practice, as well as others in the industry, and I believe the MSRB has said this as well, to generally include an independent advisor on those transactions to make sure you're getting the best deal possible for your school.
Another piece that I thought was fascinating coming out of the report was that just the number of non-rated credits in in the public markets. So for a head of school or CFO who like doesn't follow the bond market, what does a non-rated credit signal even mean? And should this be something that a board should be thinking about?
Yeah, most independent schools don't have a credit rating, and they don't necessarily need one. If you're going out and you're getting a loan from a commercial lender directly, that lender will do its own credit diligence. They've got a whole team of credit analysts that work in the sector. It'll go through a credit review committee, and then you'll get approval. You really only need a credit rating in a public offering of bonds setting, and that's generally used to signal to third-party investors your creditworthiness. A lot of these investors, they're running mutual funds or other types of funds, and they don't necessarily have the time to go through and do a lot of rating analysis on the securities that they own. And so they rely on the rating agencies, S&P, Moody's, Fitch, and others, to effectively inform them on the creditworthiness of the underlying securities that they hold. As I mentioned before, there's sort of a normal distribution of credit quality in the independent school sector. You have a lot of really good, a few amount of really strong credits, AAA, et cetera, AA in the space. Generally, most are middling, and then you have some on the lower end that would rate out at a B or some other kind of below investment grade rating. Now, there's a disconnect between AAA, which is sort of setting the price or getting the best price and interest rate on that, versus your double B plus, which is the start of the high yield, or some people call it junk rating, going down to B or even C or triple C. Um, for folks that are rating out at triple B plus, or sorry, double B plus, double B, it makes sense to get a rating and above. If you're below that, you may not want to get a credit rating because you don't necessarily want to signal to the market exactly what your rating is. There's some benefit there to keeping it non-rated. There's some of the mutual fund managers and other investors can again sort of do their own analysis rather than having a stamp on the school that maybe says, okay, the rating is too bad. But it does come at a cost. And some of these schools that are being non-rated may not know what their rating could have been because they may have been misinformed or because they're rushing through a process. Adding a credit rating does add time before you can sell the bonds. Sometimes it's as long as 4 to 5 weeks. Generally, it's within that 3 to 4 week time frame. And so some folks are in a rush. They have a project that they need to fund and they need to get the money out the door. But if you're rushing, you're sort of leaving money on the table in terms of getting the full story and telling investors, okay, exactly, what sort of creditworthiness that you have, and maybe not getting a higher coupon or a higher interest rate, but a lower interest rate that does save you money down the road, even if it costs a little bit more in terms of time. And so probably, Peters, we haven't done the, analysis of each of these, but probably there are several non-rated independent school transactions, publicly, offered transactions every year that likely would have benefited from a credit rating. Again, if you're a borrower out there that borrows through a direct institution like a commercial bank, you don't need one generally as part of that process.
One thing I hear a lot about is just in general costs are up across the board. Operational costs are up across the board. But that is true also for construction costs. Interest rates are higher.
Mhm.
Schools are amortizing stuff over, in some cases, 40 years. So, what does all of this tell you in terms of how schools are managing the financial pressures around capital projects? Like, what's your take on that?
Tuition rate increases can only go up so high, right? To afford and absorb some of these increased costs, both on the borrowing side and on the project cost side. So we're seeing schools get smarter about what projects they're investing in. We're seeing schools start to focus really on fundraising as the core repayment method for a lot of these capital projects before they go out and close on some debt. They want to see that they're making progress in terms of raising towards a capital campaign goal. And if they don't meet that goal, they either reduce the scope of the project or they wait a little bit longer. We always work with some schools as well that are trying to get something put in place and think that the fundraising will come down the road. It's a little bit riskier. Obviously, it does work at times. You've been talking about a project for 10 or 20 years. A lot of donors will sit on the sidelines and say, I'll donate when I see it happening. But we see a lot more of our clients start to wait and start to focus on the fundraising as the backbone of those, or look at smaller smarter projects that they're looking to fund, and really more mission aligned, and sort of saying, okay, what does this do from an ROI perspective, return on investment? It's going to look both for prospective families and current families. Is it going to increase our enrollment? Is it going to increase our auxiliary revenue? That's a really big term that folks in the independent school space have been talking about since COVID. How do we reduce our reliance on just tuition, because we know that tuition rates can only increase so much per year before we start having a problem? And how do we start introducing other non-tuition based revenue, from summer camps or space rentals or what have you, and just really start to pad the income statement in other ways? And so folks maybe are looking less at the flashy projects, big stadiums and other things, and sort of like, how is this going to play on our P&L, not just from a cost and a borrowing perspective, but also from an income perspective.
I can't even tell you how many podcast episodes we've done on auxiliary revenue and the phase of it. So it's like it definitely is like that's definitely a conversation that is very prevalent in our world right now. I'm curious, what's your thoughts on schools endowing maintenance for these projects? Do you find that that's typically the case? Should that just be an absolute whenever a board is approving a capital project?
I don't wouldn't go so far as to say it's an absolute. It can be difficult to sort of endow a building, right? It's not always easy for the advancement office to go out there and raise money for a building that's not going to be used directly in construction. Obviously, it would be a best practice, and if everybody had the fundraising capacity to go out and fundraise to support the depreciation of each building they put out there on an ongoing basis, fantastic. We think that that is definitely something that you should do. Not everybody has the benefits there. There's oftentimes still a gap between what the capital campaign can raise and the cost of the building itself, which has to be generally funded either through long-term debt that's amortized, or through your own cash balance that's then repaid, right? Or replenished, excuse me, from operating income. So not a lot of schools have that. If you are this type of school that does have that fundraising capacity, by all means, go out and do that. We think it's a great idea. It's only going to make it easier for you to get debt and pay off debt. But most majority of the schools, yeah, sort of again, two standard deviations from the mean, probably do not have that
Yeah.
fundraising capacity.
It raises an interesting question of what percentage of schools actually hit their capital campaign goals? Like, I'm super curious, is it 80%, 90%? I have no clue. I don't know. I've never seen any data around that, but it does beg the question that if you're falling short, what does that ultimately mean when it comes to, the maintenance on the building long term? Um, Speaking so kind of building on that, do you see a trend towards more targeted capital campaigns rather than something that's, more comprehensive? And if so, like, what do you what would be driving that shift? And is it, what do you think of that approach?
Yeah, I mean, full disclosure, I'm not an advancement officer
Yeah.
here or someone that specializes in fundraising. I know enough to be dangerous on the subject, particularly how investors and lenders want to see a capital campaign pulled together. But I think you're right, Peter. I think a lot of schools out there are really sort of maybe taking a second look at a campaign and saying, all right, rather than $60 million that we're going to fund X, Y, Z, A, B, C, it's going to be we're going to fund this project at 10 million, this other project at 5 million, and then maybe some for the endowment. I think that especially with some of the uncertainty we've seen in the past 6 years, there's been some donor fatigue and
Mhm.
some uncertainty about, well, I am a donor, I'm committing to a 5 to 7 year. We've seen 10-year pledges as well, of giving $1 million+ amortized over that time frame. What's going to happen in 5 years, 7 years? Am I going to have the funds available to even meet these obligations? And so, um, I think that it's getting similar to the projects getting smarter and tighter. We've seen some of the campaigns getting smarter and tighter, and if they're campaigns, they're actually going to be phased, right? So we've got a lot of these schools that have campus master plans or master site plans or whatever you want to call them, where now that we've got these phases to that campus plan, and the campaign is phased along with those campus plan phases. So, you know, you would have a $20 million campaign for phase one. then you'd have a $15 million for phase two, et cetera, rather than a $60 million and trying to fund all three or four phases all at once.
Right, right. That makes a lot of sense. That gives you more flexibility to get to goal. Uh, Robert Ryan, director, First Tryon Advisors. This has been terrific. If somebody wants to reach out, what's the best way for them to do that?
Yeah, our contact address is right on our website. You can just Google me, Robert Ryan, First Tryon Advisors. Look me up on Claude, OpenAI, or
There you
ChatGPT. I'm
go.
sure I'm on there too. LinkedIn also works. Just shoot me a LinkedIn message.
Great.
I'll respond. Generally email or website or LinkedIn.
This has been terrific, Robert. Thanks again for doing this. I really do appreciate it. And for those of you who are part of Moonshot Lab, hang tight. The extended interview will continue in just a second. But again, Robert, thanks for joining me on the show.
Thanks, Peter.